some pressure on realty names or the real estate sector overall. But does it happen for all the markets? How far it could go? And what's the outlook going forward? We are now joined by Pankaj Kapoor, founder and MD Liases Foras, for understanding the real estate market scenario. Mr. Kapoor, good afternoon. Thank you so much for joining in. I remember we had spoken in November. You did indicate that there could be some structural changes coming by in the realty industry overall. Have things worsened since then? We have one real estate player, listed one, which is now talking about some demand softness. I think that's the first one that we are hearing now. Do you think we will continue to see this commentary coming by from more players in the near future?
In fact, if you look at the market has actually slided down around 7 to 8% from its peak, which was early last year. And post that, there is sales wise in terms of the unit, the market is down by 7%. But the major concern is the constructed supply, like the productions done by the developers. So even though the marketable supply has grown over the period of time because the builder launched the projects and also could generate the booking, but their execution is falling behind. So from 3 billion to 3.5 billion introductions of the marketable supply during last 3-4 years, the constructed supply has been holding at 2 billion, and sometimes it has gone down to 1.9 billion square feet. That means that builders are not able to keep in pace with the launch supply. The construction is not keeping pace with the launch supplies, and that is what is creating a structural issue. Builder will not be able to book the revenue, and there would be a default and execution delay in the projects, and which has a long-lasting impact on the overall real estate market projects viabilities, because if the construction slows down, then the interest cost and construction cost adds up, and then which impacts the margin of the developer. But in overall sense, that the volume have gone down by 6 to 7%. But in terms of the value, it is not looking that bad because the market was still skewed towards the luxury and ultra luxury market. And I think the demand softening is also from the angle that the prices have peaked in most of the geography. The investor participation has reduced because most of the geography, the price rise has been in the range of 0 to 5%. Some of the North Indian market, which was showing a high price rises, are showing a plateauing situations because as the new launches is coming, the competition is coming, the price is not growing as much. So investor sentiment is a bit down, and luxury can't continue to actually support the market all along. The demand has to, or the supply has to meet the distributions of the demographic and demand segmentation. I think those corrections will be taking place going forward.
Mr. Kapoor, what you've highlighted is, from the peak, we've seen a 7% downtick in terms of volumes. Is there a particular geography where you've seen more stress compared to others? And you've also highlighted an important point in terms of real estate builders' balance sheet under a bit of stress due to not being able to launch on time. How worried are you?
I'm saying that there is not much of the worry, and mostly I see that like Delhi NCR already have a very limited supply because in comparison to MMR regions, if you see Delhi NCR, the total supply is 1/5 the size. MMR, if it has an unsold of close to 3 lakh unit, Delhi NCR is still holding at a level of around 60 to 67,000 units. So it is much limited and contracted supply as of date. But some market like Pune, we have seen a reductions big way. We have seen to some extent Delhi, Ahmedabad, Chennai, and to some extent in Hyderabad, there's a bit of a reductions in terms of the volumes. But overall market actually is still holding up. In tier 2 cities also, we have seen a growth getting arrested. And one more thing which I noticed during this particular quarter, we have seen prices of around 18% projects across out of 20,000 projects we cover. have shown a reduction in the property prices to the extent of 0 to 5%. So clearly indicating there is a softening of the demand in the market, and builders are finding it difficult to entice the investors, and they are trying to make the deal more lucrative, and that's where they started giving offers and discounts.
So, Mr. Kapoor, we just have a minute. So, I just wanted to understand the pricing bit. Was the demand slowdown a lot to do with affordability as well? And if there are price cuts, do you think that could revive demand?
My own sense is the market is post-RERA has really been highly dependent upon the demand and supply. So the geographies where the price rise been very high, like Noida, Greater Noida, Ghaziabad, and North Indian places, where there was a supply constraint because a lot of new supply was not coming in comparison to the rest of the geographies across India. The limited supply was giving an opportunity to the developers to really speculate and increase the prices because marketable supply was very limited. And my own sense is builder wants to really maintain certain cash flows, and so they have to maintain the velocity, and that's why they started offering discounts and offer. And it's more to do with the demand supply rather than other issues. And I'm not seeing too much of price correction risk because rental yield across most of the geographies are very good. Mumbai itself has touched close to 4% of the rental yield on an average. And that's kind of thing above 3% rental yield we are seeing in majority of this geography. And that's where I see that the prices have productivity. We don't see a big price correction risk, but one thing is that the price rise is moderate, and so as the discounts offer also been in the moderate range
Got
of
it.
0 to 5.
Got it. Mr. Kapoor, apologies, we are completely out of time, but thank you so much for joining us with your insights on what's happening in the realty space. A lot to do with the demand-supply issue, not so much pricing. But with that, we'll take your leave on this edition of Midcap Radar. Quickly taking a look at what's happening